On November 6, 1978, President Jimmy Carter signed the Revenue Act into law. Deep within the hundreds of pages of mundane tax code was a tiny, obscure provision, just 3 paragraphs long. It was labeled Section 401, subsection K. At the time, no one paid it any attention. It was drafted not as a grand vision to secure the retirement of the American middle class, but simply as a technical fix to limit the tax advantages of cash-deferred bonuses for a few highly paid banking executives. Yet, those 3 paragraphs inadvertently triggered the largest transfer of financial risk in modern economic history. They dismantled the traditional corporate pension system and funneled trillions of dollars of retail capital directly into Wall Street, permanently altering the mechanics of the global stock market. Today, we are going to examine the crown jewel of this accidental system, the 401k employer match. Often dismissed with the cliché, "It's free money," the true nature of the corporate match is far more complex, far more cynical, and infinitely more fascinating. By the end of this video, you will understand that the 401k match is not a gesture of corporate benevolence. It is a mathematical anomaly, a highly calculated corporate tax strategy, and the last true risk-free arbitrage opportunity available to the modern retail worker. To understand the sheer power of the 401k match, we must first strip away the generic personal finance advice and look at it strictly through the lens of institutional capital allocation. Imagine, for a moment, that you are a hedge fund manager on Wall Street. Your entire career, your entire compensation structure is based on generating alpha, returns that beat the market average. You employ phalanxes of PhDs, utilize satellite imagery, and lay billion-dollar fiber optic cables across oceans just to secure a fraction of a percent of outperformance. If someone walked into your office and offered you a guaranteed, instantaneous, risk-free return of 50% or even 100% on day one of a trade, you would assume it was illegal. In efficient financial markets, risk-free returns of that magnitude simply do not exist. They are arbitraged away in milliseconds. Yet this exact mathematical anomaly sits untouched by millions of workers every day. Let us define the mechanics. A 401k is a defined contribution plan. Unlike the defined benefit pensions of the mid-20th century, where the corporation assumed all the investment risk and guaranteed you a set payout until the day you died, a defined contribution plan shifts the risk entirely onto you. You decide what to contribute, you decide how to invest it, and if the market crashes the day before you retire, that is entirely your problem. To incentivize you to participate in this system, corporations offer the match. The structure is typically formulaic. An employer might match 100% of the first 3% of your salary you contribute, or perhaps 50% of the first 6%. Let us translate this into cold, hard, institutional terms. If you earn $100,000 a year and contribute $6,000 to your 401k, a 50% match means your employer instantly deposits an additional $3,000 into your account. Before the underlying assets have moved a single cent in the open market, you have realized a 50% return on your capital. It is tax-deferred, meaning the government is effectively subsidizing the initial capital outlay, and the compounding begins immediately on a principal base that is 150% of your actual cash commitment. There is, of course, a mechanism of corporate self-protection baked into this: the vesting schedule. Employers rarely let you walk away with this capital immediately. They employ either cliff vesting, where you own nothing of the match until you hit a specific anniversary, say 3 years, and then own all of it, or graded vesting, where you earn the right to the capital incrementally over several years. The vesting schedule reveals the secondary function of the match. It is a golden handcuff, an employee retention tool designed to reduce the friction and cost of corporate turnover. But to fully grasp the gravity of the match, we have to look past the Human Resources Department and look directly at the Internal Revenue Service. Why do corporations offer this match? It is tempting to believe it is rooted in a moral obligation to ensure the financial well-being of their workforce. The reality is far more structural. The 401k match is fundamentally a legal bribe required to pass strict government compliance testing. To understand the unseen engine of the 401k, we must look at the IRS non-discrimination tests, specifically the actual deferral percentage test or the ADP test. When the government created tax-advantaged retirement accounts, they knew these vehicles would be disproportionately utilized by the wealthy. To prevent the 401k from becoming an exclusive tax shelter for the C-suite, The IRS implemented a mathematical ceiling. The tax code categorizes every employee into two groups: highly compensated employees, or HCEs, and non-highly compensated employees, or NHCS. The definition shifts with inflation, but essentially the executives and top earners are the HCS, and the rank-and-file workers are the NHCS. The ADP test dictates that the average contribution rate of the highly compensated group cannot exceed the average contribution rate of the non-highly compensated group by more than a couple of percentage points. Let that sink in. If you are a CEO wanting to shelter tens of thousands of dollars of your income from the highest marginal tax brackets, you are mathematically handcuffed to the financial habits of your lowest paid employees. If the rank-and-file workers decide not to contribute to the 401k, perhaps because they are living paycheck to paycheck, the average contribution rate of the NHCE group plummets. When that happens, the plan fails the ADP test, the corporation is penalized, and the executives are legally forced to take their contributions back, paying heavy income taxes on the returned funds. The corporate match, therefore, is not a gift. It is a calculated expenditure to artificially inflate the participation rate of the lower-tier workers so that the top-tier workers can max out their own tax shelters. The free money is the price of admission the corporation pays to the working class to keep the executive tax haven legally compliant. Many companies sidestep this complex annual testing altogether by adopting what the IRS calls a safe harbor 401k plan, by agreeing to legally mandate a specific non-discretionary match, usually 100% on the first 3% of salary and 50% on the next 2%, or a flat 3% contribution, regardless of what the employee does. The company is granted an exemption from the ADP test entirely, but this engine goes even deeper. By the late 1990s and early 2000s, even the lure of free money wasn't enough to get workers to fill out the paperwork. Participation was lagging. Enter behavioral economics, spearheaded by academics like Richard Thaler. They realized that human beings suffer from severe inertia. If the default option was not to participate, workers would leave the free money on the table. The systemic solution was auto-enrollment. Corporations began defaulting new hires into the 401k plan at a baseline contribution rate, usually just enough to capture the match. The psychological burden shifted. Instead of requiring action to opt in, it required action to opt out. This seemingly minor administrative tweak created a macroeconomic leviathan. Today, every 2 weeks, like clockwork, hundreds of billions of dollars are automatically extracted from corporate payrolls, instantly matched by corporate treasuries, and blindly fired into the global equities market. This capital does not care about price-to-earnings ratios, it does not care about geopolitical tensions, and it does not read earnings reports. It is a massive, highly predictable, price-insensitive bid on the market, overwhelmingly funneled into passive S&P 500 index funds and target-date retirement vehicles. The match is the fuel for this perpetual market engine. To truly comprehend the stakes of this system, we must look at history. The transition to the 401k was not a smooth evolution. It was born from crisis and refined by disaster. Consider the collapse of the Studebaker Corporation in 1963. When the legendary automaker went bankrupt, its defined benefit pension plan was drastically underfunded. Over 4,000 auto workers who had traded lower wages for the promise of a guaranteed retirement lost everything. It was a national scandal that shattered the illusion of corporate paternalism. This catastrophe eventually led to the passage of ERISA in 1974, the Employee Retirement Income Security Act, which attempted to put guardrails on corporate pensions. But the regulatory burden of ERISA made defined benefit pensions so incredibly expensive to maintain that corporations began desperately searching for an exit strategy. The obscure 1978 tax code, Section 401k, became that exit door. By the 1980s, corporate giants like IBM and General Motors began freezing their pensions and ushering workers into these new self-directed accounts. But the early days of the 401k were a Wild West, leading to our second and perhaps most vital case study, the Enron Corporation in 2001. Before its spectacular implosion, Enron was Wall Street's darling, and Enron offered a very generous 401k match. There was, however, a fatal catch. While employees contributed their own cash, the corporation matched those contributions not with cash, but with newly issued shares of Enron stock. Furthermore, Enron locked that match stock. Employees were legally forbidden from selling the company match until they reached age 50. Management continually urged employees to invest their own contributions into company stock as well, touting it as a sure thing. By 2000, over 60% of the assets in Enron's 401k plan were held in a single asset, Enron stock. When the accounting fraud was exposed in late 2001, the stock went into freefall, plummeting from $90 a share to pennies in a matter of months. Executives operating outside the 401k restrictions aggressively sold their shares. The rank-and-file workers could not, because their match was locked in company stock, and because the plan administrators froze the accounts during the crash, the employees were trapped inside a burning building. They lost not only their jobs and their health care, but over $1 billion in life savings evaporated into the ether. The Enron disaster proved that a company match heavily weighted in employer stock violates the most fundamental rule of finance: diversification. It concentrates an individual's human capital, their job, and their financial capital, their retirement, into the exact same risk profile. The fallout from Enron directly shaped the modern 401k match. Congress passed the Pension Protection Act of 2006. This legislation legally empowered the auto-enrollment mechanisms we discussed earlier, but more importantly, it strictly regulated the use of employer stock for matching contributions, allowing workers to diversify out of company stock much faster. It codified the modern framework where the match is typically paid in cash and immediately deployed into heavily diversified, age-appropriate target date funds. The system was patched, but the risk remained entirely on the shoulders of the worker. Zooming out, the macroeconomic implications of the 401k and its matching mechanism are staggering. We have fundamentally financialized the American workforce. Today, the U.S. retirement market holds tens of trillions of dollars. The continuous, automated flow of matched contributions creates what some economists argue is an artificial floor beneath the stock market. Because this money flows predominantly into market cap-weighted index funds, it disproportionately allocates capital to the largest companies in the world: Apple, Microsoft, Nvidia, regardless of underlying business fundamentals. The 401k match, aggregated across millions of workers, is arguably the single largest driver of the passive investing revolution. It has altered market liquidity, suppressed market volatility, and fundamentally changed the mechanics of corporate governance, as asset managers like Vanguard and BlackRock now control massive voting blocks of proxy shares funded by your bi-weekly paycheck. The defined contribution experiment, birthed by an obscure tax loophole in 1978, has successfully transferred the liability of an aging population from the corporate balance sheet directly onto the individual. You are now your own chief investment officer, whether you are qualified for the job or not. But within this daunting reality lies the power of the match. Understanding its origins, that it was born as an executive tax dodge and is maintained as a compliance mechanism, strips away the illusion. It is not corporate generosity. It is a structural inefficiency in the labor market that you are mathematically obligated to exploit. To ignore the match is to volunteer for a pay cut. It is to subsidize the tax shelters of the highly compensated while accepting all the risks of modern capitalism with none of the institutional leverage. The 401k match is the ultimate financial paradox. It is a system designed to protect the wealthy, functioning as an automated, risk-free wealth creator for the middle class. The free money is there, quietly waiting. The only question is whether you understand the machine well enough to reach in and take your share.